Good afternoon and welcome to the Asian Midday Market Watch. Our guest today is Kelvin Wong, Market Strategist at CMC Markets. Now, Kelvin, thanks for coming in.
Hey, hi, Happy New Year. Good to see you again, Brian.
Yeah, with your first show of the year. Now, before we get your insights, let's start and take a look at how crypto markets have been performing, and they've been performing rather poorly. We start with Bitcoin, which is at 42,696.8. It's down 7.98%. Ethereum is at 3,417.85. It's down 10.36%. Now, over at stock markets, we start with the XGX, which bucks the overall trend. The SGX is at 3,179.91. It's up 0.52%. If you look across other regional markets, we've got the KLSC, which is at 1,533.73. It's down 0.92%. Shanghai is at 3,589.5. It's down 0.16%. The ASX All Ordinaries is at 7,663. It's down 3%. The Nikkei is at 28,536. It's down 2.71%. The Hang Seng is at 22,787.5. Is down 0.52%. And rounding up the numbers, we've got the Kospi, which is at 2,930.9. It's down 0.78%. Now, Kelvin, what's your view on how markets have performed this morning?
Yeah, so if you look at the current situation right now, yeah, it's a sea of red almost in Asia, across the Asia benchmark stock indices. But some of the markets are faring slightly better as compared to the rest, which we highlighted earlier. Number one would be the STI, the Singapore STI. And as well, quite surprisingly, in the last couple of days, the underperformer, the one that's related to China market, which is the Hang Seng Index, and the Hang Seng Tech Index, is also performing relatively better compared to the US benchmark indices, which actually fell close to 2 to 3% overnight, which is we're talking about the S&P 500 and the Nasdaq 100. So one of the reasons, I would say the main catalyst that actually kind of triggered this kind of I would say not really significant, but more pronounced decline in the US benchmark stock indices will be definitely the outcome of the Fed FOMC meeting, which slightly caught the market participant off guard. So I want to highlight this part over here is that, number one, we know that 3 hikes is being penciled into the what I call it, the Fed funds futures market for this year. So that doesn't came as a surprise for the market. So what came as a surprise was actually this unwinding, the start of the unwinding of the balance sheet. Okay, so I want to talk a bit more about this unwinding of balance sheet. It's slightly different from QE tempering. Because QE tempering is just actually reducing the amount of purchase, the current QE purchase that actually embarked on during the pandemic crisis. So this balance sheet unwinding was actually the accumulated amount of bond buying that was actually kickstarted since this 2008-09 financial crisis, where they actually kickstart their QE program to buy up massively the bond market via the Treasury market and via the other MBS market. So the Fed balance sheet has really have a tremendous amount, close to about 5 to 8 trillion. So what the officials actually did highlighted during the previous FOMC meeting, which is in December. So it was actually noted down in the meeting yesterday that was released yesterday, saying that they actually don't mind in concurrent while hiking interest rate. At the same time, they will actually start to unwind the balance sheet as well. So this is a bit different from the previous hike cycle, which is around in 2010, around 2010, 2011. So at that point in time, yes, they start to hike interest rate, but they were actually almost about close to 2 years before they start to unwind their massive loads of balance sheet. So what it means, it actually translates to what I call a potential more drastic kind of tightening of liquidity condition from this, if this stance is being embarked on. So what we could see over here is that if you talk about, if you put any correlation chart in the last couple of years, right, there's the growth of Fed balance sheet has a very strong correlation with the up movement in the US stock indices, be it the S&P or be it the Nasdaq 100. So right now, this growth of this of the Fed balance sheet now is being drastically reduced as in it's being brought forward in time instead of waiting after or during the mid-cycle of the interest rate hike cycle, they actually want to do it concurrently. So that caught a bit of a fear factor into the US market, which is actually very natural to actually fall off the cliff. Why? Because if you look at the last 2 weeks, the S&P 500 has been performing quite well. In fact, they actually made a fresh all-time high during the last week of December. So it's pretty much of a nature phenomenon to actually, since being caught off guard, there will be a bit of panic of profit taking, I would say, at this point in time. And also, if you look at cryptocurrency, also start to fall similarly as well. Okay, so the reason over here for sure that we start to see that at this point in time, cryptocurrency, we're talking about diversification benefits against equities, and cryptocurrency doesn't seem to be at play right now, because everything now still boils down to the picture of the amount of liquidity that is running in the market. Same thing, because we talk about cryptocurrency, our view cryptocurrency is still more or less like it's not a bond or it's not like a fixed income. It's more like a bit of an asset that people will tend to have capital gains instead of fixed dividend or periodic coupon payment. So I view cryptocurrency at this juncture, it seems to be a bit more of a growth asset rather than an asset that is considered as defensive in nature or wealth preservation asset, like we talk about government bonds or even corporate bonds with AAA grade rating. So at this moment in time, that's why cryptocurrency actually fell off across the board because of the risk of greater tightening in the financial market, as kind of a directed or depicted by yesterday's FOMC minutes kind of a outlook.
Now, Kelvin, I want to take a look at Treasury yields, and I understand you have some stuff to share with us.
Yep. So let's take a look at this US Treasury yield, and that could actually explain. This is a 10-year, so that could actually explain also that sell-off in the Nasdaq 100, because Nasdaq 100 actually underperformed yesterday versus the S&P and the Dow Jones. So the Nasdaq 100 actually fell close to 3%, and some other stocks, tech stock actually fell much more. So we'll talk about more about that later. But before that, let's look at the Treasury yield. So you can see that the Treasury yield since the 20th December low, it started to shape a strong rebound off from this key medium-term pivotal support at 1.36%. And what we could see the last couple of days is a tremendous up move. Right now, it's about to test a potential swing high that was made during 30th of March last year, which is at 1.77%. So what we could see that this movement upwards, right? If you look at the upward movement that was seen 2 or 3 days ago, actually correspond to the outperformance of the Dow Jones Industrial. In fact, Dow Jones Industrial last night made a fresh intraday all-time high before it collapsed together with the rest after the release of the FOMC minutes meeting because of the liquidity issue that will actually impact all the market. And one of the reasons why the Dow Jones is actually leading this week is because of the rise of the 10-year Treasury yield at a faster pace than the 2-year. That means we're talking about a upward sloping in the yield spread, which is actually beneficial for banks in terms of their net interest margin. And so given that Dow Jones Industrial has a more heavy weightage towards the financials, all right? So now the key thing is definitely this key resistance to watch 1.77. So if we start to see a further push up to 1.96%, this will start to see a bigger risk to growth company. So especially growth company that have weaker balance sheet and lower profitability ratio. And these companies, right, we talk about growth, we still growth, it can be in AI or it can be in EV, but it's a growth story. But however, they have not yet developed what I call decent profitability metrics or figures, and their operation require a lot of debt. So that could be a problem going forward if the US 10-year Treasury yield keep rising, which actually indicating to us there is actually a higher cost of funding to running such operation, their business operation. And this can be depicted right in this very famous ARK Innovation ETF. So everybody knows ARK ETF.
Yes.
They have a very strong performance in 2020, where actually they rose close to more than about 100% over here. But however, if you look at since its all-time high in February 2021, it has been trading in a downtrend. And even it didn't actually make fresh all-time high 2 or 3 weeks ago. If you look at the chart over here, it's actually trading in a kind of a descending, we call it a channel, with the next support coming at a 140. And the break above this level could take it much down lower towards the bottom of this channel, which is at 63.90. If you look at the performance chart of it versus the S&P, it's been trading a very clear downtrend as well. And even versus the Nasdaq 100, we also comprises of tech and growth company, but the higher weightage, which is Apple and Microsoft, they're actually, yes, even though they are tech and growth company, but they do have stronger balance sheet. If you look at their cash hold,
Yes.
if you look at their profitability metrics versus the component stock inside ARK. So that gives rise what I call to explain the current underperformance of ARK against the broader market, and potentially it could still see further downside potential ahead, given the current negative technical elements that is being inherent on the chart of ARK ETF, ARK Innovation ETF. Pardon me.
Now, Kelvin, thank you very much for your analysis and your insights.
My pleasure, Brian.
Now, we've been speaking to Kelvin Wong, market strategist at CMC Markets, on Biztech's Asian Midday Market Watch. I'm Brian Fernandez. Check out this video and podcast on our various social media platforms, as well as our website, www.biztech.asia. Please like and subscribe to our various platforms. Thank you very much for tuning in.